My guest today on the Alpha Exchange is Mark Rosenberg. He is the founder of Geoquant and a adjunct professor at University of California, Berkeley. Mark, it's a pleasure to have you on the Alpha Exchange today.
Thanks so much for having me. Looking forward to it.
Very much looking forward to this conversation. Risk is something we think about a lot on this podcast. And when most folks dive into that topic, they're thinking about monetary policy. They might be thinking about corporate earnings. Perhaps it's a crowded trade or a derivative that blows up. But what we're going to really talk about here is the idea of political risk, which I think really can make its way into markets, but is certainly more difficult to measure. And that's something that you have a lot of expertise in, and I think it's going to be very relevant at this point in kind of the market cycle of trying to understand what's going on. Let's get our conversation going. Tell us a little bit about your background. You've got a PhD in poli-sci, and tell us a little bit about your career history.
Yeah, so as you said, I'm an academic by training, a political scientist by training. Did my PhD at Berkeley, really focused on actually African politics. And I'm South African by birth, but not by accent, as you can tell. Grew up mostly in California, but also heavy focus on kind of game theory and quantitative methods. After a brief stint in academia, really wanted to get into kind of applied political science such that exists, and stumbled upon something called the political risk industry or the country risk industry, and a company called Eurasia Group, where at the time it was kind of branded as the political science company, and it was one of the private sector outfits that I had heard of that was prominent in the space that was doing, that hired political science oriented folks to do kind of private sector work. And so I happened to have I spent some time at a tech startup during my PhD. So also again had some sense of kind of wanted to do applied tools, and Eurasia Group actually had a South Africa analyst job open up right after I finished my PhD. I had done my dissertation on mostly on the ANC in South Africa, and so that was my kind of regional expertise. And so I started there as a South Africa analyst, and really kind of quickly realized a couple of things. One is just how much politics can matter and political risk can matter to markets, and certainly not always. And I think we'll get into that in a minute, but just how relevant this factor can be in certain contexts. And secondly, just how little contemporary political science was being employed in the industry, in the kind of country risk, political risk industry. And when I mean contemporary political science, I mean kind of model-based, data-driven political science. Political scientists like me were kind of trained like economists, for better or worse. Lots of political scientists would say for worse, and kind of the school that I was raised in and my advisors, et cetera, were certainly think it's for the better in terms of being more systematic, model-based, and data-driven. And so we're really trained in a lot of the academic work that we, particularly if you focus on political economy, which I did, was really about kind of connecting politics to economic outcomes. And that kind of, and oftentimes using, pretty rigorous tools like game theory or econometrics. And that seemed to be, ultimately what the job was in terms of being a political risk or geopolitical risk analyst. You were trying to explain how, certain political conditions were going to affect your clients', investment or commercial outcomes. But we really weren't using any tools that had been developed in political economy and political science to do that. We were just kind of being experts and talking about it. And that certainly has a lot of value. And I think is still the way a lot of the industry is consumed as kind of reports or conversations. But the insight I had was, well, we can measure these things. And once we measure and quantify, then we can make really explicit the relationship between politics and markets. It's not really about style of presentation or who you last spoke to at the central bank. All of that is important. But when we think about integrating politics structurally or systematically into a risk management strategy or an asset allocation strategy, it's it's a lot more useful, I thought, to have that be kind of model-based and data-driven than be so idiosyncratic and subjective. And that was really what Geoquant, how Geoquant came about.
In the classic political science rendering, the word science may not necessarily be, we think about it in the hard sciences world, where it's, truly data driven, it's measurable. And I think that's where we'll go with your launch of Geoquant. You talked about this notion of country risk. And so if I think about the risk of a country, we certainly have economic risks where, perhaps there's large budget deficits or unsustainable inflation or unsustainable monetary policy. And then we have this idea of governance. And I'm sure a number of these factors make their way into some metric. I'm just curious, if you go back, a decade ago or 15 years ago, this idea of country risk, what were the inputs roughly that were being, scored and picked up on?
To your point there, in country risk, there has been quite a lot of data around economic risks, core macroeconomic, outcomes, stuff like debt to GDP or current account balance, et cetera, right? Inflation rates, et cetera. And typically, that's how, when there's a data-driven approach to assessing country risk, it usually relies heavily on macroeconomic or financial fundamental data, right? What was missing really on that was fundamental data for politics, right? And that is, and measuring things like governance. And that has always been done and still is largely done in a more qualitative or subjective way. What was used, to the extent there was data being used, was oftentimes things like the World Bank governance indicators, which are still heavily used by financial services and rating agencies, et cetera, as a kind of quantitative input. Things like where I used to work, actually in between undergrad and graduate school, I worked at an organization called Freedom House, and they assess democracy. And that's kind of how I got into this space and got an understanding of how those indices were created and maintained, et cetera. And so there was also use of those kinds of indicators, kind of more survey-based, qualitative, expert-based kind of wrap-ups of and quantifications of things that were in and of themselves generally not considered quantifiable. And so it was generally that kind of input. Now that input is valuable, and in fact, we use a lot of those inputs at Geoquant in our model as kind of underlying historical data. But by and large, that data is backward-looking. So it's capturing a time period, in the past as opposed to the present. A great example right now is a lot of folks around my world of country risk and political risk, and especially including on the buy side and in all sorts of investment contexts, are waiting for the World Bank to release their world governance indicators this year, which are much delayed for reasons that we're not quite clear, but it's heavily relied on, right? And so in general, you would get these problems with these kinds of indicators where they would be, generally, they wouldn't be maintained systematically. They were highly subjective because they were generally based on the analysts inputting them. They were backward looking and they were infrequent. They would come out, once a year. And so unlike the economic data, which even if it's a smaller emerging market or frontier market, you're probably still going to get that, quarterly, if not monthly or daily. Political data or anything trying to measure anything in the governance realm or the political risk realm was very infrequent and usually very backward looking.
As you, again, talk about country risk, my own background is from the University of Chicago. And so there's, a school there that's really seeking to try to look at market prices, returns in the context of expected risk, right? Trying to sort of think through risk factors. And I'm wondering, was there research at all that tied perhaps, let's say, the cross-section of country risk to the cross-section of returns? Is there any literature in the kind of old period that looked at that?
There was, absolutely. And there were kind of two general findings. The first was that these kinds of factors, governance and political risk, just matter far more in emerging markets than developed markets. Just in that generally kind of conventional reasons of, institutional strength and policy predictability, and also just financial and economic development. Politics would matter more to investment or commercial outcomes in an emerging market than a developed. And so by and large, there was a pretty sensible disregard of political risk, at least as a kind of anything greater than a really structural, slow moving factor in developed markets, because it really just didn't matter to markets. And then with emerging markets, much more attention paid to it, but not a lot of quantification around it. The other kind of takeaway from that literature is really, and not surprisingly, these kinds of factors are most relevant to kind of sovereign level assets, right? So things like currencies and currency and exchange rates, sovereign bonds, right? And particularly in commodity exporters, kind of country level equity markets, right? Where you would get a kind of, you could invest in a country, right? That was by and large dominated by a certain industry, and that industry was highly political in many ways because it came out of the ground, right? And the government owned it by default. And so that was kind of the conventional wisdom. And that's why the political risk industry really, in the corporate space, really developed among extractive companies, particularly oil companies and mining companies, because they were dealing with, fixed assets in the ground. And in financial services and asset management, it was largely focused on fixed income, sovereign debt, FX as well by proxy, but FX was trickier, right, in terms of the kinds of factors involved in FX movements, et cetera. So FX was always relevant, but in terms of something kind of more consistent, it was generally around kind of basically, sovereign debt, sovereign ratings, et cetera.
And if we, again, just back before your founding of Geoquant, where we're going to spend a lot of time, if you think through an episode or two, or an example or two of where the analysis or the understanding of something that was, let's say, particularly nuanced. We all read the Financial Times and The Economist, but I think the value is really in truly understanding, some of the nuances in relationships, where there are instances where either the narrative or some version of a macro market price were just really out of step with, the facts on the ground, if you really understood them, that you can recall?
I can give you like one micro example and one macro example. The macro was not anything that I dealt with personally, but it was just something I observed while being which was around kind of the euro crisis and the kind of widespread expectation that the euro would collapse, right? In the context of the euro crisis, and that Germany would abandon, Italy or Greece or Spain or et cetera. And that there wasn't a kind of larger geopolitical kind of constellation of interest, like holding that unit together. And that was one kind of macro example of where, at least in terms of some of the interactions that I was having with clients in those early days after my PhD, there was that gap that really needed to be filled, that Germany would not defect and would not ultimately kind of rid itself of, if anything, the other way around. It would double down on kind of European integration, again, for better or worse, depending on your perspective. The other was really kind of formative in my career, which was right when I started at Eurasia Group and kind of getting into the sense of this applied political science. South Africa had a series of really violent mining strikes. I'm not sure if you recall, it was around 2013. It moved South African sovereign assets, especially the rand, but also because South Africa makes up such a big portion of platinum deposits, and this was mostly concentrated in platinum mines. It moved platinum and palladium, and it was a real market story coming from this relatively small emerging market. And it became very clear to me how understanding not only the nuances, I was able, for instance, to get a lot of traction with clients and have success as an analyst because I understood the dynamics of the trade unions in South Africa from my dissertation work on the ANC, which has been in a formal alliance with trade unions since the anti-apartheid movement. And understanding the divisions in the trade union movements and how these strikes were being led by non-traditional trade unionists, not affiliated with the ANC, who weren't necessarily under the control of the government, and thus, government-aligned capital in a way that previous trade unions were, and so that there was a much bigger risk here of kind of a conflagration and shutdown in the mining industry. And also then understanding structurally, right, that this wasn't going to metastasize much beyond, platinum and gold, that there were different dynamics in the mining industry which suggested this would, hold, but it wasn't going to go to, automobiles and South Africa did at that point had more of a kind of a heavy manufacturing landscape as well. Again, micro, but it was the structural understanding of the political economy which helped kind of identify the floor, but it was also the understanding of those nuances of trade union politics that helped identify the risk, right? And that helps a lot of our clients make money on the downside on the rand, and then on the upside with recovery, as well as on some of the related commodities.
It's almost as if you're trying to trade the policy response. And as you referenced the Eurozone crisis, that certainly was formative for me in the sense of how market prices can really become unwieldy. And if you don't solve them quickly, they could overwhelm you. And so what do we have? We had Trichet at the helm of the ECB and, kind of muddled along the best he could, but didn't have as definitive, at least wasn't able to as strongly articulate what his intentions were as Draghi was in mid 2012. And so that was defending a currency from falling. And then I think it's only a couple of years later, I want to say it's January 2015, when the Swiss National Bank walked away from their peg. And they were trying to prevent their currency from strengthening and ultimately just gave up. I think it was January 12th or something, just out of nowhere. So these are ultimately political decisions, oftentimes with vast economic outcomes or financial market outcomes.
Exactly. And all of these were around the same time. And when I just started to get into the industry, and so they're pretty kind of formative of, at certain periods, this really does matter. And that outcomes like, big sovereign outcomes, including things like sovereign defaults, et cetera, are almost always politically driven, right? It really always almost is. Obviously, ability to pay is a huge factor. That's what puts the country in the difficult situation to begin with. But there almost always is a way to avoid the outcome of default, right? That is almost always a political about willingness to pay. And it's a political decision based on domestic factors, international factors. And that was also so clear in those years that it kind of set up, wow, this is really a systematic risk factor in the market. It is not as much of a risk factor as the economic and financial factors that are clearly, driving hour to hour, minute to minute, day to day kind of market movements. But there is something systematic here.
So let's go talk about your founding of Geoquant. Tell us about the motivation and just how you started to execute on this business plan.
Initially, I actually proposed the idea to my colleagues at Eurasia Group, just because I was there, doing very well there, a lot of smart people there. They had a very good brand in the market, and I thought, hey, a smart colleague of mine now at Teneo, which is a kind of competing consultancy, Kevin Kajuari runs that political risk group at Teneo. He told me something really smart when I first started Eurasia Group. He said, people pay us to talk to smart people about countries that they don't know about. And one thing that occurred to me was, well, if you could quantify that, right, you could sell the data about countries that produced by smart people that the clients don't know about, right? And that they could integrate more directly to their process. But, ultimately this wasn't a company that really was investing in technology and wasn't really investing in data as much as they were investing kind of in marketing and their existing product. And so I said, so they said, thanks, but no thanks. And I said, okay, I'm going to leave and do it myself. And I ended up getting venture backing I built a prototype with a friend of mine who was a very experienced computer engineer in Tel Aviv. So we actually moved to San Francisco together and started building this prototype. And then we brought that before Excel Innovate, which was the venture arm of XL Catlin, which was then subsequently acquired by AXA. So it became AXA XL, as well as in front of a Israeli venture firm called Alish, partner called Michael Eisenberg, who's very was a very prominent investor in the VC space. They really liked the idea. They had co-invested together in a company called Lemonade, which is an insurtech company that's done quite well. And so, frankly, I never intended to be a kind of the CEO of venture-backed technology company. I really just wanted to kind of get this idea in the market and then see, how it fell among my network of folks at Eurasia Group and Teneo, et cetera, and figured, one of them would pick it up. But as kind of fate had it, ended up, starting the company myself and getting a fair amount of venture capital behind it. Our first client was Bloomberg, and our top line indicator for the G20 is still on the Bloomberg terminal, and almost 10 years later. And started to realize that, hey, there's a real business to be created here in terms of getting data into the space, political data to go along the economic and financial data. And this was around 2016. So we had Brexit, we had the Trump election in the US. We had, what at the time was considered a very kind of high risk or uncertain election in France. There was the Turkish coup. There were all sorts of, or attempted coup. There were all sorts of events that helped kind of evangelize the need for this in the market.
Can you talk about that early period, that 2016? As you say, it's rife with just some unbelievable events. Brexit was a fascinating one because, the betting markets were early days, not Kalshi or Polymarket, but you had something there and they were telling a different story, relative to surveys and things like that and polls. Just tell us about 2016 as you were getting your product going and how you kind of covered these events.
Yeah, that was that input. So exactly as you described, the gap between betting markets, which were much more developed in the UK at the time, so they were liquid and like pretty decent signal, and polls and kind of conventional wisdom around Brexit was one kind of, here there's alternate data that can tell us something, right? That's not being captured by existing political data. And also when we started building the Geoquant data set and started to gather data, which was really about taking kind of conventional wisdom and political economics, again, drawing back to some of those conclusions from academia where we could say, okay, with some certainty, X political variable generally leads to Y economic outcome, right? And start to kind of model that and codify that. When we started gathering data around that, we saw, for instance, a picture of the United States socially in particular that was like a lot less stable than I would have thought, right, than my priors were. And that the potential for a destabilizing outcome or surprise outcome in an election in the United States, we could talk about that later, was a lot higher than the conventional wisdom, right? And we weren't in a position we now have a very sophisticated election model, and we're about 86% accurate in terms of forecasting election results. We didn't have that then, but we did, some of our initial research was just saying, in particular, social risk in the United States is much higher than appreciated, and the potential for a surprise outcome is much higher than appreciated in the 2016 election. And so, likewise, one of the first, once we brought the system live, one of the first events that really hit the system and that we started processing was the attempted coup in Turkey. And we saw, wow, this is, this kind of near-term processing of political data into a structural view of political risk. And of course, Turkey was already, I used to describe it as the country, it's like the political risk gift that keeps on giving. It just continues to, generate different narratives and different kind of political risk events. It was already like that. But the coup and how it, failed and then stabilized, but then led to significant institutional change, all that was something that we tracked really well. And we're able to demonstrate that. And that was, we didn't have any clients at the time. We were just raising money, but it really helped validate the prototype in that you could gather this kind of alternate data. And a lot of what we do is also using news and unstructured data from news and kind of structuring that to create high frequency information, not just sentiment, which was, if anyone's ever played with sentiment, knows is very, very tricky, but kind of domain infused and domain guided sentiment analysis. It worked. And that was kind of a great validation for us. And then the world has just kind of continued to trend in that direction.
So just back to the 2016 US election. There are those mashups you can see on YouTube, which are, you know, time after time, someone in the mainstream media making a joke about Donald Trump's chances. I think USA Today was going to cover his campaign in the comedy section of its paper. There was so much groupthink there, and very few people picked up on it. The polls were all one way, and I think that groupthink is very much a thing. It's sort of it's a social equivalent of crowding, in investing, right? What if you could try to describe the nuanced pieces of data? You said social kind of fracturing, maybe one part of it. What were the things that were, there to be picked up on that were just not obvious to anyone on, CNN that was reporting on this stuff?
And to your point, I remember when I was still at Eurasia Group, Ian Bremmer, in his general kind of talk to investors would say there's a 0% chance that Donald Trump will win the 2016 election.
Nothing should ever be zero.
Yeah. Which is a perfect explanation of why Geoquant was necessary, because obviously there wasn't a 0% chance just mathematically, and also we needed a different way of approaching. So a lot of what we saw, and again, we didn't have it explicit, just to be clear, we have an explicit forecast that Trump would win. We just said this election is high risk, right? And you spoke about risk is a latent variable, right? It's something that doesn't emerge until it does, right? Until the event happens. And so you inevitably produce a lot of false positives when you're trying to assess risk. The key with doing it well is not doing that so frequently that, when you do assess a risk correctly, you're just not credible. And B is actually assessing, getting those risks that were underappreciated. So to the point, to answer your question, what we saw, first of all, there was as a South African, I kind of had some familiar with the South African technology, because there was actually a South African media company, a media analytics company that was out there saying that Trump was going to win based on their assessment of social media. And then when we did some similar stuff, we just saw also much higher level of engagement, et cetera, with the Trump campaign than with the Clinton campaign. We kind of took that and combined it with what we were seeing structurally in the data that we were gathering, which was just a US political economy that was just highly fractured and highly polarized, from everything from demographic and kind of like ethno-religious fractionalization, which sounds very wonky and political sciencey, but basically just means what is the kind of distribution of ethnic groups in a country. And there's some pretty, from African politics in particular, there's some, pretty well-founded research that says as group sizes get to a certain level, particularly when a majority group their majority status becomes threatened. There's even a term for that called a threatened majority. That they tend to start becoming more radical in politics and start seeking out more ethno-political entrepreneurs or kind of candidates that speak to ethnic grievance more. And that was what we saw in the United States. I mean, if you looked at US demographics and if you looked at white Christian Americans relative to non-white Christian Americans, we were really approaching a point where, we were at the 50-50 point. Hugh did a bunch of interesting research about this at the time. Then you saw just socioeconomically, you saw outcomes that were just, striking in succession in terms of, STEM educational outcomes, even the beginning of the life expectancy drop that we see here in terms of health outcomes, general kind of educational attainment, and how that vary spatially, rural and urban, right? Again, another really good indication that, this was a political economy that was kind of ripe for disruption. And so those were some of the social data points. It really wasn't anything, about this kind of specific group in Wisconsin going this way or that way, right? That kind of micro. It was really kind of, hey, this country just doesn't look as stable as one would think. And so Given also you're seeing in the social media analytics, the potential for a destabilizing outcome is a lot higher than we think.
How might that be different just broadly versus what Nate Silver at 538 was doing at the time?
Yeah. So that was very much a statistician's and like a polling model, right? It's taking one thing about American politics. So I was trained in, comparative politics. Sorry to indulge just a little bit, but we assess lots of countries and compare them. And American politics folks generally just concentrate in the United States. And one thing is they have a ton of data. They don't really need to go creating their own data because they just have so much of it. So much of it is polling. And so what Nate Silver and others were doing there was just really taking the massive amounts of polling data that are available in the United States and, using some pretty, sophisticated techniques to model them and make forecasts about what that meant about, the outcomes at a state level, which he had done to much success. I forget which election, maybe the 2018 midterms or the 2014 midterms or wherever, 538 kind of made its name. But they were really taking polling data and making a polling model, right? And there's a lot, because you have so much data, you can really, you can have some powerful models. We were very different. We were taking model kind of the data that you would typically use in an emerging market to assess, things like social risk or social polarization or kind of institutional risk, et cetera, and then applying that model to the United States and saying, oh, this country looks a lot closer to an emerging market than one would expect from, the spread in sovereign bond yields or the US dollar or et cetera, et cetera.
We're going to talk, the bulk of our conversation is going to be about the US now and how Geoquant scores, certain factors that you look at and how we should think about the risks there. I want to back up 5 years ago and talk about, call it December, January, and February of 2019 into 2020. There was a lot of information out there just around, the potential exponential spread of airborne viruses, what was happening in other countries. And I think it's as of February 20th, I think the full lockdown was 2 or 3 weeks later, but the VIX was at 12. Credit spreads were super tight. And so it was not as if this information got processed. And of course, there's always potential for false positives, as you indicated. But you were getting charged very little to put that false positive trade on, is my point. Just give us a sense as to what your models were doing, at the end of 2019 into early 2020.
We take a kind of bottom-up approach to measuring political risk. And we divide it into 3 buckets: governance risk, social risk, and security risk. And within social risk, there is a factor that's called health risk. And basically, the short version is we saw, obviously not surprisingly, given the news flow, et cetera, health risk exploding, right? But traditionally had a really low weight in overall political risk, right? Because health risk events historically don't move, markets. So what we really did to kind of capture COVID and with some success in terms of the analytics, at least, is just reweight the model. We just, we just created a kind of COVID or pandemic type model where we just overweighted health risk and in general social risks relative to, say, policy risks, right? Which generally are much more important to market outcomes, or even security risks, things like, geopolitical events or political violence and terrorism, again, to the extent that there are kind of domestic events that can move the market that are not policy related. It's, some kind of terrorist attack or something like that. We noticed that in the model. That wasn't anything that we had proprietary. It's just, as you say, kind of the narrative started picking up. And so what we were able to do is really just reweight the model and then say, okay, here's the delta, or like between what our baseline model is saying and what our COVID model is saying is for each country. And we actually use that delta to then look at that against, try to get a sense of, basically create a risk screen of where, relative to baseline, there was the highest risk of kind of COVID level instability or disruptions. And that turned out to be really effective. And it also was a pretty decent proxy for kind of, effectiveness of public health response, because the way the model worked was that you generally tended to get kind of bigger gaps and higher COVID risk premium in countries where there was kind of less cohesive societies and where there was a less capacious state, right, where state capacity was low.
Well, you and I were recently introduced by Jens Nordvig, who founded Exante Data and has been on this podcast. And I, have been very interested in the idea of U.S. as a source of risk. I think the U.S. is typically the country that serves as a stabilizer for the world, right? That's the global policeman, biggest economy, most efficient markets, best rule of law. And perhaps that's not always. And there's certainly, some signs that is just wavering. Perhaps some of it's, as you alluded to, the social fabric fraying. So let's just talk about what you see now. And then let's frame it as, I believe you've written a recent op-ed piece for Barron's that essentially was talking about the U.S. as a source of systemic risk for markets. So why don't you give us the big picture of that, and then we can dive into, what Geoquant is picking up on.
To your point and to your introduction, what the core finding in our data really is that, as I said in the beginning, in 2016, when you looked at the United States, you saw a polity that was not necessarily the most stable socially, right, or institutionally than you would expect. Those trends have just accelerated so dramatically since then.
Was it the pandemic that did it, you think?
I think it was some of these structural facts. Certainly the pandemic accelerated things. And I think before that, obviously there was a financial crisis, et cetera. And I know many folks would talk about, the kind of rise of social media and those kinds of technologies and kind of the way people are processing information. All that is true, but all that is also true in almost every other country in the world, right? And that's just kind of where, as a political scientist, you start to think, okay, United States, though, has really seen the most, and we can look at the data in a second, has seen the most dramatic, of all the developed markets, the most dramatic increase in political risk over this time period, looking the closest to a developed market, I would done an emerging market than any other developed market. You could talk about UK and Brexit, et cetera, but I think it was pretty safe to say if the UK were going to hold another Brexit referendum, it would lose. And if you looked at the parties now, you back to kind of milquetoast, Rishi Sunak and Starmer and kind of Labour and the Tories, et cetera. Whereas the United States, we elected Trump in 2016 and then we did it again in 2024. We're taking another ride on the kind of destabilizing roller coaster, right? And so what we've seen in the data is really a significant increase in social risk, social polarization in particular, definitely accelerated pre-pandemic by the financial crisis and rising inequality, right? Then kind of culturally, right, very much by the pandemic as well. But structurally, again, this underlying society where the previous dominant, ethno-religious group is no longer dominant. That's something that, as a scholar of African countries, I could say that's a recipe for instability. So that has accelerated, right? And I think got caught up in a lot of the kind of narratives of the different political parties. Institutionally, the United States, again, has a particular vulnerable set of political institutions. There is another developed market that has something like the Electoral College. There are other developed markets that are strict two-party systems like us and have, first past the post elections. But there isn't really another one with a Senate that is, constructed to kind of exaggerate rural and urban divides, or, tamp those down, or kind of overrepresent rural areas. And so what we have also is a particular set of institutions that social risk starts ramping up, and then the institutional risk is vulnerable to ramping up as well. And then finally, what you see in the United States, the kind of classic EM pattern of social instability leading to institutional stability, which then leads to what markets actually care about, which is policy instability and policy uncertainty. And that we've obviously seen in a serious way this year. And there is that immediate policy risk, right? In terms of, what are tariffs going to be tomorrow, or what's going to happen with the central bank, or, is there any credible ways that the United States can address its debt, and all those kind of really specific policy risks, or what is the Supreme Court going to decide about tariffs, and how does that impact, the fiscus, and how does that impact, et cetera, et cetera. And then there is the structural or kind of more idea-based institutional strengths of the United States around, the full faith and credit of the U.S. government, and the dollar as a reserve currency, and U.S. Treasuries as the quote risk-free asset in the global financial system. And those kinds of risks to those kinds of factors are very hard to quantify, but they are clear in some of the market movements that we've seen in 2025, particularly when the dollar and yields came unhinged for a little bit, at the general kind of hedging of the dollar, right, this year, but also in just the general kind of acceptance that the United States, the kind of Fed independence and or credible fiscal policy, or the expectation that, international agreements, commercial international agreements, not political ones, because those the United States has never respected those, but commercial international agreements will be respected, et cetera. All those assumptions are with good reason much weaker, if not gone. And as a result, we have just a very high level of policy uncertainty with a very high level of latent risk that is kind of premised on the fact that there is now, in this kind of regime, there is just a lot less certainty about if there is a crisis, that the U.S. government and U.S. sovereign will be the one to bail out of that crisis. It's now we're in a space where the U.S. sovereign could be the source of that crisis. And that is a fundamental change in the way that I think investors should think about global financial markets. That doesn't mean that the S&P 500 is going to crash. That doesn't mean that the dollar is no longer the reserve currency, or that treasury yields aren't still the cleanest, dirtiest shirt in the global economy. But what it means is that the expectation that the U.S. sovereign will act and has the tools to act to allay or seriously mitigate the next financial crisis is seriously in question, depending on the political prerogatives of the executive. Because we've already seen that this executive, and then more broadly, the institutional landscape of the United States is just not as predictable as it was.
I had tweeted this out. This was a Bloomberg headline that just blew me away. This is just a headline. It says, White House denies that Trump threatened lawmakers with execution, which is just, to even have this as a headline is just tremendous. You mentioned the market price reactions earlier this year during the tariff tantrum, very unwelcome decline in the dollar, rise in bond yields. These are things that are supposed to go the opposite way during a risk off, right? It's supposed to be a flight to safety. And so if you're tying kind of your work at Geoquant to market prices, we talked about, perhaps showing a few charts on things that you see. I think that'd be great, to put those on the screen if you have a couple.
This is the Geoquant platform.
Okay.
This is the kind of default Geoquant platform. It's you can see here how we define political risk on the right-hand side. We've got, political risk divided into, as I mentioned, these kind of buckets of fundamental risk factors. We have governance risk, we have social risk, and we have security risk. Underneath all of those are a number of drivers. So just by way of example, part of governance risk is going to be government risk, how strong the government is in a particular country, how stable it is. That's going to be a function of its mass support, its elite support, its institutional support. What political science would tell us are the factors that determine whether a government will rise or fall. Policy risk is a function of, rule of law, and then micro, macro, and investment trade policy risk in a country.
So rule of law is something that you're ultimately creating a numerical value for.
Correct. Yeah. For every country in our system, which is 146 countries, we have a daily score for rule of law risk.
And tell us just how you arrive at something that doesn't sound quantifiable.
Yeah. So what we'll do, so we can use the United States as an example. What we'll do for rule of law risk is we have a kind of series of structural factors that tell us, where the U.S. fits relative to other countries in the world. And so, if I kind of give you a sense of where that was, let's say around 2018, you could see, where the U.S. falls. Still, pretty low risk on the overall scale, but up there for a developed market. And we would get that data from the World Bank Doing Business Survey, the World Bank Governance Indicators, Transparency International, the Global Integrity Project, the World Justice Project, Freedom House, right? As domain experts, we have a pretty good sense of what instruments are out there that measure rule of law risk at a country level and that are credible and have a decent enough data series that we can include in our model. And then what we do to update those structural indicators is really pull in the news. So you can see a range of news here, and we can just go to more recent news just so you can Justice Department crisis over Eric Adams showed up from February, et cetera. A range of news being pulled on from a variety of sources that tells us something about rule of law in the country. And we add that to the indicator. And so what you see here in the solid line is what we call a composite that takes all that structural data from Transparency International, et cetera, combines it with the data from the news flow, and creates an update to that structural risk score on a daily basis. And then we also have, we call the pulse, which is this kind of more sentiment-based indicator that we often use to look at things like, say, the VIX, et cetera, that also, are more volatile indicators. And so when it comes to the United States, just one kind of really interesting figure to look at here is that here I'm showing you our top line political risk score. So it's our top line aggregate, right, of political risk in the United States.
So we don't really want this number to be going up.
We don't want this number to be going up. No. And we certainly don't want this number to be extremely highly correlated with something like gold price. So let me just show you.
Great point.
This graph, right, which is one of the most striking in our system, which is just the extremely tight correlation. It's like 0.96 or 0.94. And of course, these are two linear, indicators in this time period, both going kind of systematically up with some variation, right? But it's still amazing how tightly correlated our top line U.S. political risk indicator and gold price are, and how that's been the case since 2017, right? So it's not just 2025 and Trump 2.0 here. This is, I think, solid grounding for a structural basis for a higher gold price based on higher U.S. political risk. I think that's something that is now accepted in the narrative, but that there isn't really a measure for, and it's something that we were forecasting in 2020 based on this kind of this relationship, right? At the same time, and this is kind of the Jekyll and Hyde nature of being a political risk analyst, I'll show you another graph here, which I kind of created for these purposes. Let me just pull it up, which should be U.S. political risk versus the S&P 500. Excuse the excuse the generic stock price index. Havers, it is a tricky beast in Jupyter notebooks.
Well, here's what I would say to that is, to me, it actually creates a risk because we stare at stock prices. They are validation. They are wealth. They are some report card on success. And yet it allows us, it's sort of like the pre-GFC era. We missed things because things were going so well. And so I think this is a blind spot, is how I would interpret this.
I agree. Now, obviously, that's talking my book, so.
Mine too.
And it's a book that would not have performed particularly well if you were just, looking at U.S. equity markets at this time period, right? But the two together, I think, tell a very interesting story. And what is underlying that is also, just to give you a sense, like if I took the US risk indicator here, again, just to go back to where we were, and I also included, say China on here, right? We'll just give it a second to show up. What you'll see is, and I can, get rid of gold to kind of clean stuff up a little bit for us, is that, what we're seeing here is a convergence of political risk in the US and China. And the US is still lower political risk than China, but it started off a lot lower than China in this period. And at least our model is telling us a story of a pretty significant convergence. And that is part of what we've, and I've termed since about 2020, this EMification of the United States, where the kind of political dynamics and structure of the United States looks increasingly, the level of political risk, according to the Geoquant model, looks increasingly like now looks more like an emerging market in terms of average emerging market political risk, which is that yellow line up above, than average developed market political risk, which is that blue line down below. Now, you could note, again, as I said previously, the US already started at a structurally higher level of risk than a lot of other developed markets for the reasons we discussed. But it's increased significantly over this time period. Other developed markets have also increased. You can see that blue line going up too, but not nearly as much on average in the United States. And so what all this means, again, is that we're in a world, obviously the United States still has the largest, most liquid capital markets and economy in the world. It has the world's most powerful, far-reaching military, right? Those are also structural factors that are going to be slow to change. But politically, in terms of the predictability and the kind of institutional stability of the United States, it does look more like an emerging market than a developed market. And that is, I think, a fundamental risk to global markets. And that's where we think, U.S. political risk is a systemic risk.
So let's talk about 2026 midterm. To me, what appears to be a win at any cost for both sides. At every turn, in terms of I just call it a U.S. political civil war, because that's really what it is. And we're just bystanders, unfortunately. But this is a significant year. Trump loses even one of these branches, the House or the Senate. It's kind of over for him. The redistricting initiatives on both sides, it's an intensification. What do you see as Geoquant in terms of its analysis, the data, the stories, the metrics it's going to be picking, trying to analyze? Give us a sense as to kind of what your sense is telling you.
So the first place we look is to our election model, and our election model basically just assesses a probability of turnover. So it takes the incumbent party, right, and it says, what is the likelihood that the incumbent party will win or lose any particular election? And so, generally speaking, right, structurally speaking, right, we're in a midterm election, right? Generally, that's anti-incumbent in the United States. There's a clear historical record of that. And then a lot of the metrics that we looked at that led us to predict that Trump would win in 2024 quite early. So we predicted that in March or April of 2024. In terms of social polarization, socioeconomic stress, et cetera, those have not, reverted, right, to baseline for the United States. They're still high and elevated. So all of that would tell us, an anti-incumbent outcome in 2026. What is, I think, to your point, really worth monitoring here is that if you remember that rule of law graph that was also going up, some of the institutional stability graphs have been going up, things like civil liberties, right, risk have been going up. So the potential for a, contested and disputed election where there is significant uncertainty about the outcome and even a refusal to accept the outcome by certain parties, right, which again is recent history in the United States. The potential for political violence, which has increased significantly in the United States around that election. All of those things that, again, this is what I would analyze in South Africa, Brazil, or Turkey, or Malaysia, right? Not the United States, but they've become the reality for the United States, where we're looking at a major political event with the potential for, sustained political violence and or sustained political uncertainty in terms of the nature of the government and the policies that government would pursue. Then we have, so there's that event. Even before that, and the kinds of things that we're looking, there's the structural facts of the political calendar. There's obviously going to be a move on the Federal Reserve, right? Just by virtue of, so there's going to be a kind of major event in terms of the Federal Reserve. There's going to the shutdown that was ended recently, longest shutdown in government history, expires on January 30th, right? We're not looking at a particularly conducive environment to getting that resolved. And we have the fracturing of, at the beginning, the first real fracturing of Trump's domestic coalition, the MAGA coalition, whether that's Epstein or foreign policy or growing concerns about self-enrichment, et cetera, what the Secretary of Defense is facing right now, right? We do see a significant weakening of the incumbents' coalition. And one can interpret that in two ways. The first is that should be, that should help deflate risk because we have a weaker incumbent, right, who's just less able to maneuver and do risky things. And generally, I think of Trump as someone who's, sitting at the poker table and just going all in on each hand because he has so many more chips than everyone else, right? We've all played against someone like that. What is interesting, and I don't gamble very much, but I have friends that do, and so they get these special non-negotiable chips or the special casino chips that you can't get back, right? And those, I think Trump is also spending with pretty reckless abandon. And so the question is, once his chip pile starts going down, more and more, and our chip pile starts going down, does the behavior become more risk averse or more erratic? And there's plenty of political science to say the latter, right? In that, generally, particularly in authoritarian settings or kind of quasi-authoritarian settings, when, a leader who is particularly, who starts to get weaker and has, particularly with legal concerns, et cetera, might behave more erratically. And then there's plenty to say that that leader would kind of tone down his or her policy actions or kind of institutional actions in order to kind of, because they just have less power to do so. All of that creates significant uncertainty. So basically that is trying to describe to you the lens by which we will be analyzing the next year, right? It'll be in that kind of political science sense of trying to gather data around those factors, right? Not just, who wins a special election in Tennessee or how, polls are looking for the midterms, or really, do we see kind of what is the reaction function of this government relative to weakening what we would call institutional support or elite support? Does policy risk increase or decrease? Can we start to see a pattern of that? Because thus far we have, one bright spot for the United States is that policy risk is highly responsive in our data to elite support risk. So basically, in non-jargons, when elites, particularly financial economic elites, get upset about policies, the policies generally change. And we saw that with the bond market in a serious way, right, with Trump. And that's the whole foundation of the taco trade, et cetera. That's the kind of thing we'll be looking at. Does that stay? Does that start to diverge? If it starts to diverge, we're in pretty dangerous territory.
It's a great point that the bond market, the VIX, these risk measures were sort of some form of governance that imposed themselves on maybe Scott Bessent, who transferred that knowledge to Trump, who, climbed down quite significantly. Here's where I wanted to end. You did a transaction with Fitch in 2022, I think. Fitch downgraded the S&P, downgraded the USA a notch in August of 2023, and not a meaningful, downgrade. But what was meaningful was the nature of the commentary. It was your classic stuff. The debt trajectory looks unsustainable. The interest costs are high. Medicare and Medicaid and social programs are at risk. But they also mentioned very much a topic of this conversation, which is governance. the fraying of our capacity to govern ourselves. And so I just wonder around the ratings agencies, very much lampooned in the aftermath of the GFC, you were late and so forth. But I do think they matter, and they're clearly watching this stuff. I just was finish this out with your own thoughts on, how the governance or the challenges we're having might interact with ratings agencies.
So I'll give you definitely my own thoughts and just to issue the typical disclaimer that I now know, having been acquired by Fitch, which is that my thoughts are not the thoughts of Fitch Ratings and have no bearing on Fitch Ratings assessments. And in fact, Fitch Ratings does use Geoquant as an ancillary input, but it's not a direct input into the ratings process. So with all that said, what I would absolutely call from a ratings analyst perspective, ratings negative, right? In terms of these governance events. I think there is significant, I'm trying to choose my words carefully because I still am an employee of Fitch. But from my perspective and from the perspective of the Geoquant data, the US should be downgraded, right? Again, based on its level of governance and political risk and institutional risk. Just given where it sits relative to other developed markets, right? Given the combination of that political risk with its fiscal risk. And in part, you've seen some of the more recent ratings moves that have held on a downgrade of the United States, also citing as part of the reason the offset on the budget expansion from tariff revenue. But we're not sure if those tariff revenues are going to come. And the fact that they are so variable and uncertain based on the probably politicized decision of the Constitutional Court, or Supreme Court of the country. Again, if this was an emerging market, right, that would be a huge credit risk. And so obviously the underlying foundations are very different. And there's a lot more, and there's nowhere else for anyone to go. And I'm not arguing otherwise. And that does keep a certain floor on how bad things can get in the United States. But from the perspective of kind of an apples to apples comparison with other markets, on the pure governance and political front, the United States is looking certainly like a downgrade.
Well, Mark, congrats on all the work. I think it's not just incredibly interesting, but really relevant, I think, to investors who are tasked with really just trying to understand risk. And you've got to really dig in on that front. And it certainly appears that the nuanced way in which you guys measure and quantify data on the political side is going to be very valuable in a very uncertain time. So thanks very much for the conversation.
Likewise, thanks for having me.